Morning students, welcome back to the session on audit. So today we'll first of all complete the part related to GST audit, and then we'll also start a new chapter on this audit committee and the LODR regulations, etc. So quickly coming back to the requirements of the GST audit, we understood what all different aspects are required to be covered by the GST auditor. We also understood some of the reconciliations which will form part of the GST audit. And in relation to GST audit, we also understood why this GST audit is in place and how this is really different from statutory audit or the tax auditor. Now moving on to the requirements related to this GSTR 9C, which we started in the last session. So we'll now quickly move on to some of those requirements one by one. And we have this form, as we discussed, available to discuss certain aspects related to this form which are required to be filled. As you can see, all of these requirements related to the GST audit are captured in this GSTR 9C, or we can say that GSTR 9C happens to be the document which is required to be covered by the GST auditor. Yeah. So the first part of this document comprises of the basic details about the entity which is under audit, and which is similar to what we discussed in case of tax audit, is also required to be audited by the GST auditor. Now moving further on to the second part, that means part number 2. Now, in relation to this second part, even though this has been called as part number 2, it happens to be in continuation. Okay. Now, in relation to this part number 2, first of all, let's understand broadly what all things will be covered. Now, the information, that means the financial information will get captured, and that will be reconciled with the books of accounts in various ways. And we looked at one flow chart, one picture wherein all the requirements of this part 2 were also covered. So now we will look at as to how the turnover would be reconciled in respect of the number which is reported in the books of accounts vis-a-vis the GST portal. Similarly, the input tax credit, similarly the GST liability, or if there are any additional liabilities which will arise because of any reasons in relation to the GST impact of the entity. Okay, so let's go one by one on this. So now this first sheet, this requires reconciliation of turnover, which is declared in annual audited financial statements. I'll just make it slightly bigger. I'm hoping this is visible to all of you. Declared in audited annual financial statements with the turnover which is declared in annual return, that is GSTR 9. Now in this case, turnover is getting compared. So if let's suppose turnover in the books of accounts is 105 crore, but in the GST portal or in the annual return, this has been disclosed, let's suppose, as 104 crore. So what are those reconciling items? So this reconciliation of turnover as per the books and as per the GST records are required to be given. So we start first of all with the turnover as per the book. So if you see this cell in blue color, this reflects the turnover in blue color. Okay, then the reconciling items will start. So all of these items which you can see, point number B, C, D, so on, these are all what? The reconciling items. And the good thing is that when it comes to the reconciling items, we don't need to really get on to each and every item, because most of these reconciling items are already known. So the reasons for the reconciling items also exist, and that's why most of these reconciling items will be available in the e-form or the form which is available online So that form will require you to put down the information against each and every reconciling item. For example, if we have something as unbilled revenue, which may have been booked, if we have something which is say in relation to credit notes, if there is any adjustment on account of trade discounts, if there is any adjustment on account of say forex fluctuation, so all of these aspects will be required to be captured there. And in all of these forms and at every place you will find others. So if we do not fall under any of these criterias, then we can just straight away move on to that others criteria, on the basis of which turnover will be required to be suggested. Yeah. So on the basis of this, what do? We will give the amount of turnover which will capture the impact of all of them. Yeah. So we start with the annual turnover as per books of accounts, which is then adjusted with all of these reconciling items, which you can see. And let's suppose if the turnover that we started with was 50 crore, on which we have made certain adjustments, we have reduced certain items and we have added certain items, and now it becomes 49 crore. So this becomes the adjusted annual turnover. Now this adjusted annual turnover should match with the turnover which is reflected in GSTR 9. Okay, yeah. So this is the first part which the GST auditor is required to audit. Now, similarly, there are going to be various parts in relation to the turnover, in relation to the input tax credit, in relation to the GST liability, which the GST auditor would be required to verify in the similar manner. Now, the most important point arises is about the audit procedures. Now, as regards the turnover, which is there as per the annual audited financial statements, auditor would trace this amount to the books of accounts. That means to the audited financial statements, number one. So this also means that the audited set of financial statements will become the basis for the GST auditor to start. In relation to that, he will trace the amount in the annual audited financial statements, and that will be the basis for him to start. So he will not be looking at any adjustments. He will not be changing the books of accounts. Let's suppose even if he comes across any problem in terms of recording of revenue in the books of accounts, that is not required to be changed by him because books of accounts are audited and finalized. Any of the adjustments which he believes are required to be made to reach to annual return of GST would all be made in these adjustments. Okay. Now, all of these adjustments would also have been reported by the management. So when this GSTR 9 would have been filled, all of these reconciling items would also have been filled. Now, as a next step, GST auditor would verify these reconciling items. So if any number has been reported, let's suppose under credit notes, if let's suppose any amount has been reported under trade discounts, all of these amounts will then be audited by the GST auditor. So this aspect of the audit is actually about testing of whatever is reported. Now, it may also happen that there are certain reconciling items, or there should be certain reconciling items, but those have not been captured in the GSTR 9. Okay. Now, GST auditor is not only required to check, he is not only required to verify the reconciling items which have been reported. He also needs to get down into the details in respect of turnover which is shown in the books of accounts, whether any more reconciling items exist or not. Means he needs to do this assessment independently. And if there are any more reconciling items, he would have to make sure that those reconciling items are also captured over here, and which may also require changes in GSTR 9. Okay. And then he will move on to the number which is finally reported in annual return, that means GSTR 9. Now let's try to understand certain aspects around it, how all of these items may be audited and what all procedures may be performed and what are the various sources through which GST auditor will keep tracking it. Okay. Let's look at the first point. So first we are starting with books, or we can say financial statements. Yeah. And we are reaching up to GSTR 9. Okay. Now let's suppose if I start with revenue. Now in reaching towards GSTR 9, there will be certain reconciling items. Okay. So we are saying three things will be tested by the GST auditor. One, books. For example, the procedure will be trace the sales to what is shown in the books. So this is first procedure. Then audit all these reconciling items. And audit all of these reconciling items means whatever has been recorded, he will check. So that means he will check the accuracy. Next, around these reconciling items, another procedure that needs to perform will be towards completeness. Completeness means if there are any more reconciling items which should come, this would again be the responsibility of the GST auditor to ensure. Yeah, because that is also one of the audit procedures in terms of the assertions which are required. Basis which he will reach to GSTR 9. Now, if you look at GSTR 9, this is annual return. Now, there is one path which is shown on the screen right now to all of you. Now, this path will help the GST auditor to reach up to GSTR 9. Because what's the destination? Destination is GSTR 9. Because if GSTR 9 is audited, that is in the form of GSTR 9C. Okay, but eventually this has to become accurate because this is the annual return which is going to GST department. Now let's see if there is any other way through which this GSTR 9 may be compiled. The answer is yes. One is to look at the numbers in the books on an annual basis because we are looking at annual audited financial statements. And from this we are trying to reach to GSTR 9. Other than this, if you know the requirements of GST, either the monthly or the quarterly returns may be getting filed. Monthly or quarterly returns may also be getting filed. So every month, every quarter, the entity would be filing its GST returns. Okay, wherein they will report the revenue, they will report GST liability, they will report input credit, everything which is included in this on an annual basis would have been reported by the entity on a monthly or quarterly basis. Correct? So ideally, sum total of these should also become equivalent to this one. Yes or no? Yeah. So that means as a next step, what should the auditor check? That when all of these items have been reported on a monthly or quarterly basis, were those also in compliance with the GST laws or not? Because if those were not in compliance with the GST laws, there could be certain interest provisions which may have to be made. There could be certain penalties which may not have been provided or paid. Yeah. So that is again the part which the GST auditor would be required to check and audit. And that's why we can say there are two ways through which we will reach to this. One way, of course, is nothing but the GST record, and it's about compilation of monthly records to annual record. Second is to move on to the different source, that is books of accounts, which could be the annual one through which he will reach on to this GSTR 9. Okay. Now, in relation to the GSTR 9, as we discussed, there are various items. One is revenue, which is required to be checked. Second is GST liability, which is required to be checked. Third is input credit, ITC, which is again required to be checked. All of these items are required to be checked. In terms of what is the amount reported for all of these items in the books or the financial statements, and what all amounts were recorded in respect of these items in the monthly or quarterly returns. Okay. Now let's suppose during a particular month, GST liability was not paid, or maybe GST liability was not fully paid on time. All right. Say for example, if we have to talk about the GST liability, say for the month of May, during this financial year, GST liability was not paid on time. This was paid late. Now, when this was paid late, interest or the penalty should have been paid, but no interest or penalty was paid on that. Now, in this situation, when it comes to reconciliation of books with this annual return, will this reconciliation capture this aspect? No. But should this be the responsibility of the GST auditor to check this? Of course, yes. Why? Because when the GST auditor would check this, he would understand that some interest or penalty is payable which has not been either recorded in the books or taken to the annual return by the entity, and which he would then require the entity to provide, if possible, in the books of accounts. If that is not possible, at least make sure that that is flowing in the annual return and that is also getting paid on time. Otherwise, the GST auditor will have to put the remarks around this. Okay, yeah. Moving on to the next aspect. Now, this item which has not been captured, how will the GST auditor track it? The auditor will track it by looking at all of these records. And these are also the records which are available online. So he doesn't need to get into a third source. From the GST portal, he will be able to track it very easily. Yes or no? Yeah. And all of these monthly amounts, he would also be able to verify or trace from the books of accounts. So we can also say that these two are also interlinked, because all the monthly amounts would also be flowing from the books of accounts. Yeah. So when he will be looking at all of these records, and in these records he will check that for the month of May, no interest penalty was paid which was due to be paid, then he would also check whether this was provided in the books or not. And if this is not only provided in the books of accounts, then he may require this to be covered in GSTR 9, or at least make sure that it's been paid in the it's been paid now when he is getting this GSTR 9 completed in the form of its audit. Okay, yeah. So this, I would say, summarizes various aspects related to GST audit in terms of various clauses that we see under GSTR 9C. Now what I will do is I'll just quickly flip through. I'll quickly flip through some of the requirements of those GSTR 9C one by one, and we'll see what are those reconciling items and how these are captured. So this part, which we can see, was all about annual turnover. Okay, moving further, it requires, if there are any unreconciled differences, then those are required to be reported over here with reasons. Okay, that means any exceptions will get captured over here. Next step will be reconciliation of turnover which is declared in annual financial statements with the annual return in terms of a summary. So the first sheet that we saw covered various details and various reconciling items. Now all of them will come down to a summarized form. So if you'll see this summarized form, you will see certain line items. Let's understand this. So it says, just 1 minute. It says annual turnover after adjustments. So after adjustments, what is the amount of annual turnover? Say it was 5.26 crore. Then it says, were there any exempted, nil rated, non-GST turnover? If it is some amount that is required to be captured over. Then it says, were there any zero rated supplies without payment of tax? If that is the case, amount will be reported. For example, it was 4,02,839. Yeah. Similarly, all of these items will have to be captured over here. And all of these items which are sitting and forming part of the annual turnover, even after adjustments, will then be further reduced. From the annual turnover, what do we reduce? All of these items. Because these are definitely the turnover as per GST law, but on which tax is either nil or they are exempt. So that's why, should there be any GST liability on this amount? No. So in this example, what has been done? From 5 crore 26 lakhs 44,000 and so this number, 4 lakh has been reduced. So what is the amount that we get? 5 crore 22 lakhs. Now this is the taxable turnover after making all of these adjustments. And this is also the taxable turnover as per the liability which is declared in annual return. So let's come back to this point. What do we mean by this? So we are starting with this books, and the books contain various types of turnovers. So various types of sales will be captured over here. See, there are certain sales on which tax is 5%, and there could be certain sales which are exempt. There could be certain sales which will have a tax of 0%. All of them will be captured, and after making the adjustments, all of these items will come in the adjusted annual turnover. Now, as a next step, what do we need to do? Now, as a next step, we need to ensure that from this total turnover, we derive the turnover on which tax is applicable. So that means now we need to reach to the taxable turnover. In this GSTR 9, both the turnovers would be appearing. Total adjusted turnover and total taxable turnover. So both of those amounts are required to be captured over here. Now, when it comes to some of those items which are in the nature of adjusted turnover, let me just take you back to this form. Now, if you look at this example or this line item, 0 rated supplies without payment of tax means those sales on which GST is applicable, but the rate of GST is 0%. Now, out of the total turnover, how will the GST auditor verify this? This will require knowledge on the part of the GST auditor, because he should have knowledge of the products or services which are covered under 0%. And of course, this is something which he would also check on the basis of supporting documents. So he would review the underlying transaction which was subject to GST or not. He would verify this with various documents, the invoices, the contracts, or various other e-way bills, etc., through which he will get to understand the nature of transaction, and on the basis of which he would then ascertain whether it should fall under 0% or whatever is the percentage of tax. And that will become the basis of his verification. Okay. And then he reaches out to the taxable turnover, and this taxable turnover should be the one which is captured in GSTR 9. Okay, clear? Now moving on to the next point. Now on the next point, reconciliation will again come. Now this is the reconciliation of rate-wise liability and annual amount payable thereon. So now in this part of GSTR 9C, we are moving on to the GST liability. So annual turnover or the turnover reconciliation, all of those points related to turnover are captured. Those are completed. Now the auditor wants to check that what is the amount which is required to be paid, irrespective of whether that has been paid or not. Means if the turnover, let's suppose, was 5.26 crore, what is the amount of tax which will become payable on that? Okay. And this information is required to be captured rate-wise. So if you'll see on the screen, rate-wise details are required to be captured. Yeah. And which is then broken into different types of GST categories. Means whether it is CGST, whether it is SGST, or whether it is IGST. And basis which he will get on to the total amount. So it requires a complete split of the tax liability, and this once again will have to be verified by the auditor. Now, how will the auditor verify this? Again, he will have to get into the transaction on the basis of the understanding of the transaction, on the basis of the party to whom goods have been sold. Auditor would be able to check whether CGST should become applicable or IGST should become applicable, and whether that was captured correctly in the books as well as in the monthly returns as well as in the GSTR 9. Secondly, whether the rate was correctly recorded on that particular transaction or not. Okay. Moving on to the next part. Now in this clause or in this part of the form, it's required to comment on additional amount which is payable but has not been paid. Now this will arise in respect of those differences which generally the GST auditor would find, or maybe over which certain positions have been taken by the management which the GST auditor does not really concur with, or they have a difference of opinion, because only then additional liability will arise, because otherwise it will not be possible that there is some additional liability, because otherwise management will always pay the liability on time, and they will also be ensuring that all of these liabilities would have been captured. Okay. Moving on to the next part. This is about the input tax credit now. Now in this part, what do we need? We need the reconciliation of input tax credit. And this would again be the same basis. Now as a next step, first of all, we start with input tax credit availed as per audited financial statements. Then input tax credit which was booked in financial year, means booked in earlier financial year, but that has been claimed in current financial year, which is allowed and possible up to a certain time limit. Then there could be certain input tax credit which has been booked in current financial year, but which will be claimed in next financial year. Yeah. And then we reach to the input tax credit which is as per the audited books of accounts. Okay. Now after making all of these adjustments, now the same amount of input tax credit should be reflected in GSTR now. So it's same sort of reconciliation which will have to be done with the books and with the annual turnover. But this reconciliation is not only limited to revenue as we discussed. This will capture GST liability as well as input tax credit, because all of these components will be required to be captured over there. Okay. So now I will move on to the next part. Okay. So let's say after all of these reconciliations, etc. are completed, all the procedures related to GST audit have been completed. Now what's the next part? So it's about conclusion now. Now GST audit is all completed. Everything is all closed. Everything is all done on the part of the GST auditor. Whatever reconciling items were there, those have also been reported. And finally, the auditor is required to comment whether there is any GST liability or not. Now this GST liability could be there because of the fact that the management did not pay it earlier, and this could be because of the fact that management did not know about it earlier, and which is now required to be paid. Yeah? So all of those auditors' comments, observations will be captured over here. Okay. Yeah. Now moving on to the last part. This is about certification. So we are actually moving on to the certification. Certification means you can say the report, and you will find this report no different from, you would have seen it, say in respect of books of accounts, that means the statutory audit or the tax audit. It's just that the format is slightly different, the way it appears in terms of this form. But as regards the coverage of various items, you will find most of those things to be in line with what we have seen in any other audit report. And let's try to understand all of these points one by one, because this is the most important point. As we know that audit report is the most important thing. So let's see how would this audit report start. Now the auditor is commenting we report that the audit of books of accounts and the financial statements of whatever is the name of the company. So that is required to be given. Then the address of the company is required to be given, company or the entity. So this complete address, etc. will come. Was conducted by who was the auditor and the address of the auditor. And the membership number, etc. are required to be given over here. Okay. And we annex here to copy of their audit report dated so and so, along with a copy of each of balance sheet, P&L, cash flow, or any other thing which is forming part of the financial statements. Now, can you relate to some of these things? Can you tell me if you would, if you would have found something similar to this report earlier? Quickly. If you go back to tax audit, therein the audit report was similar in nature. So what's the first thing which the auditor is capturing? So auditor is saying about the audit of financial statements of the entity. So auditor is just reporting on that. Auditor is not expressing any opinion. Means the entity which was audited and the auditor who audited and is also annexed. So the annexure has been given in respect of the financial statements with the audit report. This is not the GST audit report. This is the statutory auditor's report. Okay, yeah. So that's the beginning. That's the first step on the part of the GST auditor. Why? Because this has become the basis for the GST auditor. With this, he has started. Okay. Moving on to the next part of the GST audit report. Point number 2. We report that the said registered person has maintained the books of accounts, records, and the documents as required by GST laws, notifications, etc. made issued thereunder. So now he is saying that the GST laws, etc., whatever they require in terms of maintaining the books of accounts, that has been done. The second is books of accounts. Those are as per books of accounts are as per GST laws. So this is the second point we have been commenting. Third, the documents required to be furnished under section 35(5). What is this section 35(5)? Which requires GST audit. Required to be furnished under this. Required to be furnished under this. Herewith are furnished herewith in form number GSTR 9C. So now the GST auditor is saying that whichever document was required, those have been furnished in this GSTR 9C. So documents are furnished. Whichever was required, those have been captured. Number 4. Now the GST auditor is saying, in our opinion, now he is moving on to his opinion. Correct? In our opinion, and to the best of our information, and according to the explanations given to us, okay, and the particulars etc. which are given in the said form GSTR 9C, they are true and correct, subject to observations or qualifications. So now, as a next step, what is he doing? He is giving opinion. Opinion is again what? True and correct. And that is subject to any observations or qualifications. Okay, that is subject to any observations or qualifications. So if there would be any qualification, that would be listed below. So there's a part which is prescribed for giving any qualification. If there is any qualification that is required to be reported over here. For example, in this case, a qualification has been given. You can say observation has been given. ITC taken twice, which when identified during audit has been reversed and paid along with interest by the registered person. Registered person means the entity which is subject to the GST audit. Okay, so they are saying ITC was taken twice, and because this was taken twice, the interest is payable on that because it was a mistake. Liability was underpaid to the extent of ITC was taken twice, and now that has been reversed. So if this was taken twice, so once this has been reversed, and the interest on this liability which could not get paid, this has also been paid. So the auditor is saying that there was an observation. Subject to that observation, the particulars etc. which have been furnished are true and correct. And in respect of this observation, he has clarified that how this has been disposed of. So this may actually be an observation rather than a qualification. Okay, because herein the auditor has clarified that nothing else remains. Okay, now moving further, sign off will start. Sign off means signing by the GST auditor. So herein, because it's a form, so that's why all these particulars are required to be given. Name of the signatory, his membership number, date of the signing, place of the signing, address of the auditor. All of those particulars will be required to be captured over here. Okay, all of those particulars will be required to be captured over here, similar to we do in any other audit report. Okay, clear on this? Fifth is what? Sign off, place, date, etc. And in this case, once again, because it's an attestation, so that's why this GSTR 9C will also require a UDI. Okay, this will also require a UDI. Clear? Yeah. So I'll just take you back to the part related to GST audit. So this form that we have discussed was all about various particulars related to GSTR 9C, and idea was to just get into the various requirements which are captured over here. So we are done with our discussion in relation to GSTR 9C and all of those details which are required to be captured over here. Now let's also try to understand what's the basic approach which is followed in case of GST audit. So there are still some more points around GST audit which one should remember and which could be of importance to all of us during the examination. Now, some of these requirements that I am discussing with you, they are all based on the GST laws. And as we all understand that for the purposes of GST audit, again, thorough knowledge of GST is required. Otherwise, it will not be possible for the GST auditor to really audit this part. Now, as around GST, the entity or any entity would be covered under GST audit only if it is registered. Only if it is registered under GST, then it will become subject to GST audit. Okay. Now, as around the thresholds, let's understand the thresholds first of all. For an entity to file GSTR 9, the threshold is turnover and the turnover should be 2 crore or above. Okay. As around GSTR 9C, the threshold is 2 crore if we look at the requirements of the law. But for the financial years which are currently applicable and as per your study material, if you look at financial year 18-19, if you look at financial year 19-20, so for these two financial years, it's rupees 5 crore. Okay, it's rupees 5 crore. So that means if the turnover is less than 5 crore, then the GST audit is not mandatory. But GSTR 9 is mandatory. And 9, you remember, 9 is the document of the management. That's not the document of the auditor. Clear? Clear around the thresholds in terms of how the GST audit would become applicable. Now, as around these thresholds, another important point would be the approach basis which GST audit would become applicable. So let's try to understand that. When it comes to GST audit, so an entity may be having different GST registrations. So let's suppose this entity has got 4 GST registrations. So we can say 4 GST. Yeah. Now, for the purposes of GST, every GST registration is actually an entity in itself. Means, if it has got one GSTN at say Ludhiana, let's suppose another one is at Delhi. Let's suppose another one Kanpur, and let's suppose another one say Mumbai. Let's suppose this is how GSTNs have been taken for registration purposes. Now, for the purposes of GST audit, all these GSTNs will be considered to be a separate entity. So that means even though it's one entity, say one company, it will have to prepare separate books of accounts. for this, separate for this, separate for this, separate for this. And we are not talking about accounting requirements right now, that this is something which the accounting standards would require. This is something which the GST law requires, that separate books should be there for each GSTN, and each GSTN would file its monthly returns, would file its annual return, would be subject to GST audit. So that means if this entity is subject to GST audit, then the GST auditor would have to audit all these GSTNs, and those are all different from each other. Means 4 audits will be conducted. It's not one, it's 4 audits that will be conducted. Okay, 4 GST audit reports will be issued. But as around the applicability which has to be assessed, so the applicability of GST audit, basis this criteria of amount has to be assessed at the entity level. That will not be assessed at GST level. And let's take one example to understand this. Say if the turnover of this GSTN, or let's suppose turnover of this entity for Ludhiana unit is 1 crore, for Delhi unit is 1 crore, this unit is 1 crore, and this unit is 3 crore. So all in all, what's the turnover? All in all, turnover is 6 crore. Now, if you look at the threshold, it says if the turnover is below 5, audit is not mandatory. So accordingly, GST audit should not become mandatory to all of them. But this is not the case. GST audit will become applicable to the entity on the basis of turnover of the entity as a whole. So the first step will be to assess turnover of this entity. What is the turnover of this entity? 6 crore. Now GST audit has become applicable to this entity. Okay. Now when the GST audit becomes applicable to this entity as a whole, its execution will be done at the GST level. Audit reports which are required to be issued differently for each GSTN will be done at the GSTN level. Clear? Clear on this? From the purpose, so that means that if you look at the requirements of GST laws, then for the purposes of GST laws, each and every GSTN is considered to be a separate entity in a way, and that is independent of all of them. And forgetting the fact that it all comes down to one single entity. So Reena is asking, so that means for every GSTN we have to check the threshold limit? No, as I told you that the threshold limit you will check at the entity level in terms of applicability of GST audit. Once the GST audit becomes applicable to this entity, even if, so let's suppose if we had this scenario, here the turnover is nil. Here the turnover is nil. Here it is 1, 1. Let's suppose this is 2. Okay, and let's suppose this is only 2 lakhs. Only 2 lakhs. This is nil. Now in this case, turnover is crossing 5 crore. Turnover is crossing 5 crore for this entity? Yes. So the GST audit becomes applicable to this entity? Yes. The moment GST audit becomes applicable to this entity, even this GSTN will be audited, which may be having a sale of nil. Still this will be audited. Audit report will be issued on this. Clear? Clear on this part? And all of these points that I have discussed with you They are all coming from the requirements of GST. So, anyways, that I've discussed that when it comes to the tax audit or when it comes to the GST audit, your knowledge of these laws is most important, because on the basis of these laws you will be able to appreciate any of the things which are required in these audits. Okay, clear on this? So with this we come to an end to our discussion on GST audit. If there are any questions, any doubts you would like to have a discussion on, please let me know. I'll also pick up some examples before we move on to our next chapter. Quickly, if you have any questions, doubts. Okay, so now moving on to the example. So I'll not take a big example, a small one we can have a discussion on. Say for example, a company, say ABC Limited is subject to GST audit. All right, yeah. And the way this has been filing its monthly returns, so in the month of say June, its GST liability was say 10 lakhs. Okay, that was the GST liability, and this GST liability was paid on time. Paid on time, but for some reasons the input tax credit which was availed, that was not as per the requirements of GST law. ITC was not availed in line with GST laws. So to the extent of rupees 10,000. Means 10,000 input tax credit was, you can say, wrongly claimed. Okay, which was not eligible, but that was wrongly claimed. So Reena, this is the question. This is the question which you should expect. Now moving further on to next month, say in December, there was a GST liability, say of rupees 15 lakhs, which was again paid on time, and wherein input tax credit amounting to rupees 20,000 was not availed. Okay, input tax credit was available, but it was not availed. And if it was not availed, what happened? Cash payment was done. And cash was paid. Cash means payment was made through bank. This is also called as cash challan. Okay. Now the GST auditor has audited this aspect, and GST auditor is of the view that there's been a non-compliance to the extent of in respect of availment of the input tax credit to the extent of 10,000, which should not have been done by the management, but the management is saying that during the year itself, so during the same financial year, input tax credit could have been claimed by the management, but that was not claimed. In fact, cash was paid. So they are basically setting off each other. Okay, setting off in the sense that these two requirements are sort of nullified. And in fact, input tax credit which was not availed by the management, that is for 20,000, that is for higher amount. GST auditor requires the management to pay the interest on this amount and report this in the GSTR line. Management doesn't want to do this, saying that this nullifies the impact, and that's why there's no need to pay this. Okay, now for the GST auditor, what's the course of action in this situation? So we can again look at some options. So let's try to look at some options. First option, that if the management doesn't agree, then report this matter, okay, in audit report. And reporting means giving a qualification. Okay. Point number B, option number B, report regarding June matter. So this matter related to June, but also specify non-availment of ITC in December. So the next option will be that even though auditor will report, auditor may specify this. Because if the auditor will specify this matter, so this will neutralize the impact and this will not have serious implications for the management. Otherwise, a demand may be raised to them for payment of this, which may be a big problem to the management. Option number C, nothing needs to be done. Needs to be done in the audit report regarding this matter. Regarding this matter, nothing needs to be done. Okay. Option number D. You can all move on to this okay, option number D. Option number D could be wherein the auditor is actually I think most of the options are done. So what can be the next option? Option number D could be the one wherein the auditor can drop this point matter only if management provides specific representation. That there would not be any GST liability. Okay. Now in this situation, can you just think of as to what could be the what could be the best option? Quickly, any thoughts from your side around this? Ambika is going with option number A. And we will also evaluate all of these options now. Chavi has also chosen option number A. Now in this case, if we say that the management will provide representation letter, that don't worry, there will not be any liability in the future. Can the auditor accept it? No, because auditor has to evaluate this on his own, on the basis of his knowledge. If the management says that there is some input tax credit which is available, which was not availed by them, so does it really impact? Does it really have a bearing on the GST liability of the management because of wrong availment? Not at all. This will not at all neutralize this impact, because if there is a non-compliance, that will be independent of something like this, which may not have been availed by the management. Okay, so that's why the management should ensure that they pay interest towards this, and if that is not done, then the auditor should report this. Okay. Now to say in this situation that there was an input tax credit which was available and which has not been availed by the management, that is of no use, because there is no point reporting such a matter, because if there was input tax credit and that has not been availed, that is always available up to a certain time. If the management avails it, it's fine. If they don't avail it, then it's closed. Okay, clear on this? So that's why what would be the correct option in this scenario? Option number A. Clear? Now, as around GST audit, similar to any other audit, GST audit will also require documentation on the part of the auditor. GST audit would also require management representation to be obtained. So all of those aspects of audit will also become applicable to GST audit to the extent they are relevant. Relevant in the sense means something which is of relevance as regards the reconciliation of the audit, or as regards the limited items which are required to be audited in case of GST audit. Okay, clear? So with this, we come to an end to our discussion related to GST audit. And with this, we are done with this. And now we'll start with the next topic, that is on audit committee and corporate governance. So all of you can just move on to this next topic now. If there are any questions, doubts on this, you may let me know. No questions? All right. So we'll move on to this next chapter now. Audit committee and corporate governance. We've had certain discussions around audit committee in our previous sessions, because in respect of the auditing standards, we discussed that the auditor requires certain communications with the audit committee. We also understood that audit committee is actually those charged with governance. So that's why now we'll need to get into more details around this audit committee, and therein we'll also understand some of these audit aspects. Audit aspects means we are going to discuss about the aspects of the statutory auditor, which will be discussed with the audit committee. But audit committee is actually not limited to discussions or the communications with the statutory auditor. There are various other activities, there are various other roles and responsibilities, functions of the audit committee in relation to the in relation to the organization. So all of those provisions are what we are going to discuss in more detail in this chapter. Secondly, when it comes to the corporate governance, what is corporate governance? We can say it's about certain policies and procedures. It's about code of conduct. It's about the governance of the organization and the governance which will ensure that the objectives of the organization are achieved, because every organization will be working towards certain objectives. So all of those objectives are achieved. So that's the basis which is considered over here. Let's try to understand this corporate governance. This corporate governance is the system, we can say, by which the management of a business entity directs and controls the activities in the best interests of the stakeholders. So it's all about setting up a process, or we can say a system in the organization. So quickly looking at the legal framework. See, as around the requirements of these corporate governance and most of the requirements that we are going to discuss in this topic will be coming from SEBI regulations. We have Companies Act, which is a law, and this law requires various things to be covered by the management, to be covered by the entity, to be covered by those charged with governance. Similarly, there is another body, or you can say there is another regulatory authority. What is that? SEBI. So SEBI also requires certain compliances. SEBI has also got its rules and regulations. Now those regulations are applicable to the listed companies, because SEBI is all in respect of the listed entities. So in respect of unlisted companies, it's not the SEBI which will be the relevant authority. It's all the listed entities. So that's why when it comes to the listed entities, other than Companies Act, SEBI regulations also become relevant. And let's try to understand briefly about the role of SEBI. So what's the role of SEBI? How is this really relevant in the context of a listed company? See, when it comes to a private company we can say would generally be a closely held company. Closely held because it's owned by a certain group of persons who would have brought in their money, they have their funds invested in the company, and they have been carrying out the operations of the company as per the requirements of the law. Then the company could be a public limited company, which may not be a closely held company, or wherein we can say to some extent interest of public is involved, because that is not really a private limited company. Then there could be another set of companies which get listed. And there are various ways through which all of these companies get listed: by issuing their equity shares, by getting their equity shares listed, by getting their debt listed, and we all know about it. Now, in respect of all of these listed companies, interest of the general public is involved. And because the interest of the general public is involved, so that's why the regulations will become stringent. They will become more stringent for such type of companies. And because of this reason that the regulations become more stringent, that's why more regulatory authorities, or you can say the same regulatory authorities, may require to bring in more rules and regulations for such type of companies. And that's why for listed companies, we see this SEBI coming in with its regulations, and all of those regulations which require certain compliances on the part of the listed companies are mandatory. Now we can say the LODR regulations. What are these LODR regulations? These regulations of SEBI, which is in respect of listed companies, are called as Listed Obligations and Disclosure Requirements Regulations 2015. We can say these are categorized in two parts. First is the substantive provisions. Second is the procedural requirements. Now we will have a discussion around all of these provisions, etc., in more detail now. Okay, so we'll start with the corporate governance as around certain issues. So let's understand what are the issues which are addressed in the regulations. So whenever we'll use the term regulations, this will be about SEBI regulations, or these are very commonly called as LODR regulations. Okay, so let's understand what are the issues which have been addressed in the regulations regarding corporate governance. First, responsibilities and functions of the board. Composition of the board. Board means, so whenever we'll use the term board, it would mean, it doesn't mean this board, it means board of directors. Okay. Responsibilities and functions of the board of directors, composition, their compensation and disclosures, code of conduct and vigil mechanism in relation to the organization, composition, meetings, powers, roles and responsibilities of the audit committee, which is the most important aspect we can say in terms of corporate governance. Because primarily, if you'll see, in respect of companies wherein the audit committee is applicable means each and every company doesn't need an audit committee. There are certain thresholds on the basis of which whether the company should have audit committee or not is decided. But for every listed company, audit committee is required. And wherever the audit committee comes in, audit committee has got primary responsibility to ensure the good corporate governance for that particular company. Management of subsidiary companies, procedures related to risk management, disclosures on important issues regarding related party transactions, management discussion analysis, information to shareholders, compliance certificate by the CEO or the CFO. So these are some of the matters which have been captured over here. Moving further, let's now quickly understand the applicability of LODR regulations. So where does it become applicable? So it's applicable to the listed entities and who have got these sort of securities or any of these types of securities. Specified securities listed on main board or SME exchange or institutional trading platform. Non-convertible debt instruments, non-convertible redeemable preference shares, perpetual debt instruments, Indian depository receipts, securitized debt instruments, security receipts, units issued by mutual funds, any other securities which may be specified by the board. So if any of the instruments are listed, then the LODR regulations will become applicable to that company. Okay. Moving further, let's understand the requirements related to audit committee. Means what all things are required in respect of audit committee. So we are not talking about the applicability of audit committee. We are saying audit committee is in place. Now this audit committee which is in place, so what is required on the part of that audit committee as per the LODR regulations. Now please understand that as around this or these requirements related to audit committee, these requirements are given under LODR regulations. Means LODR regulations require few things in terms of eligibility, in terms of roles and responsibilities, etc., various points related to audit committee. Similarly, Companies Act also requires certain provisions or certain requirements on the part of the audit committee. So, in respect of a listed company, we can say the listed company will not only follow the LODR regulations, it will also be required to follow Companies Act. So we can say for a listed company, these two sort of regulations become relevant, which they will have to look into. So we'll first of all start with the requirements related to audit committee from the LODR side. Then we will also look at the requirements in relation to the audit committee as per the Companies Act. Okay, so the first one. First is about having a qualified and independent audit committee. Now, let's try to understand the role of the audit committee. See, audit committee is basically having certain responsibilities which are very important for the functioning of the organization in relation to the internal controls or the processes which are established. We can say it's the primary responsibility of the audit committee. That's why it's extremely important that the audit committee or the members of the audit committee are qualified. It's extremely important that the audit committee is independent. Okay, it's extremely important that the audit committee is independent. Now, when we say independent, independence has got the same meaning as we discussed in case of an auditor. Okay, independence in simple terms we can say means it has to be free from bias. So let's look at these requirements. Every listed company shall constitute qualified independent audit committee in accordance with the terms of reference, means the terms basis which those members would be appointed, subject to the following. It should have minimum 3 directors as members. And then again, there are limits and it's specified as to what all they need to comprise of. All the members should be financially literate and at least one should have accounting or related financial management expertise. Financially literate means they have the ability to read and understand the basic financial statements, because that is again a very important role and responsibility of the audit committee. Yeah. But out of all of them, all are not required to be expert in this area. But at least one should be an expert in this area, because only then such audit committee will be able to ensure that the financial reporting or this financial reporting process is in line with their processes which they would have established. Okay. The chairperson of the audit committee should be independent director. Now he has to be independent director, and he shall be present at AGM to answer the queries of the shareholder. Company secretary shall act as secretary to this committee. So the company secretary of the company would be acting as secretary to the audit committee. Audit committee shall at its discretion invite the finance director or the head of finance function or the head of internal audit, because internal audit happens to be a separate department, or it can be an external internal audit, or a representative of statutory auditor or any other executive to be present at the meetings of the audit committee, provided that occasionally audit committee may also meet without the presence of any of the executives of the listed entity. Okay. Yeah. Now, as around the meeting of the audit committee, means how frequently they should meet, if there's any number in terms of the meetings of the audit committee. So audit committee shall meet at least 4 times in a year and not more than 120 days shall lapse between 2 meetings. Means the maximum gap in between 2 meetings could be 120 days. And the quorum of the meeting shall be 2 members or 1/3 of the members of the audit committee, whichever is greater. Now let's look at the powers of the audit committee. So what are the powers which have been assigned to the audit committee? So they have got these powers. To investigate any activity within its terms of reference. Of course, as per the terms of the reference, if they have got any activity, they can investigate into that matter. To seek information from any employee in respect of various functions of the audit committee. To obtain outside legal or professional advice as required. Because audit committee will also require a lot of professionals or say experts to work on. Yeah, so they may, if required, engage any of those legal or professional experts. To secure attendance of outsiders with relevant expertise if it considers necessary. These are all powers of the audit committee. Now we move on to the another important aspect, and that is about role of audit committee, because with this we will get into an understanding as to what all roles are there, because all of you may be thinking that, sir, what is the role of the audit committee? Yeah, what is it that they need to do? Why has this audit committee been really set up? So let's understand this role. So they have got big list of roles and responsibilities. So we'll not just look at each and every item. We can just touch upon the roles. As I broadly told you, so they are those charged with governance. So that's why some of their key roles is about financial reporting process, is about ensuring that the internal controls or the processes around it are operating effectively. So let's look at some of these roles and responsibilities. Oversight of the entity's financial reporting process and the disclosure of its financial information to ensure that the financial statement is correct, sufficient, and credible. The recommendation for appointment, remuneration, and terms of appointment of auditors. This means the statutory auditor as well as the listed, as well as the internal auditors. So it's the audit committee which appoints them, which fixes their remuneration terms. So it's basically audit committee who has been given this function to ensure that the audit etc. is taken care of. So basically it's their responsibility. They need to take care of this. Okay. Approval of payment to statutory auditors if the statutory auditors are also engaged in any services other than the statutory audit. So its approval will be given by the audit committee. Reviewing with the management the annual financial statements, auditors report thereon before it is submitted to the board for approval. So if there are any matters which are required to be included in director's responsibility statement, changes in the accounting policies, etc. If there are major accounting entries, significant adjustments made, compliance with listing and the other legal requirements related to financial statements. So everything in relation to the financial statements and the audit observations, audit reports, it's first that it comes to the audit committee. It's discussed with the audit committee, finalized with them, and that is when it goes to the board for its approval. Reviewing with the management quarterly financial statements. So it's about financial reporting process. Now for listed companies, it will definitely be a quarterly process to be ensured. Reviewing with the management statement uses application of funds. Reviewing and monitoring the auditor's independence, because it's the audit committee which is responsible for their appointment. Yeah. So that's why in terms of the independence of the auditor, it's again the audit committee. Approval or any subsequent modification of transactions of the listed entity with the related parties. So once again, when it comes to the approval of the transactions with the related parties, a pre-approval is required to be obtained, and this approval has to be from the audit committee. Scrutiny of intercorporate loans, investments, valuation of undertakings, evaluation of internal financial controls, another very, very important area from financial perspective, evaluation of internal financial controls and the risk management systems. Reviewing with the management, performance of statutory auditors, performance of internal auditors. As we've been discussing, that audit process is required to be supervised by the audit committee. So we are not saying that they will have a say in terms of the audit which is conducted, but in terms of whether the audit is really giving the objectives which the management would have wanted or the organization would have wanted. So somebody needs to review this. Somebody needs to assess the performance of these auditors also. Who is that authority? So this is the audit committee. Reviewing the adequacy of internal audit functions. So this is again coming down to the internal audit. So discussions with the internal auditor as around any of the procedures, etc., as around any of the observations. All of these aspects related to audit are taken care of by the audit committee. To review the functioning of whistleblower mechanism. So we'll get on to this whistleblower slightly later, but again, its function is the responsibility of the audit committee. Approval of the appointment of CFO of the company after assessing their qualification, experience, etc. Carrying out any other function which is in accordance with the requirements and with the terms of their reference is once again the responsibility of the audit committee. Okay, yeah. Now, as around some of these roles and responsibilities that we have discussed, these were all coming from the requirements of the LODR. Means SEBI regulations. Means the SEBI regulations require all of these things that we have discussed. Now, as a next step, we will also look at the requirements on the part of the audit committee which are coming from Companies Act. And when we discuss this point, you will see that some of these requirements may be common. So you may think, but sir, this provision was there under SEBI regulations also, and the same provision is there under Companies Act also. So it is okay. Duplication may be there, but both the authorities, both the regulatory bodies are requiring same thing to be conducted. I think the problem could be there wherein one authority requires some provision which may be contradictory to other, but there is no such thing. All right, yeah, clear. So what we can do is we can now take a break, and after the break we will start with this provisions related to the Companies Act as rounds the audit committee. Okay, and in the meantime, if you have any questions, doubts, you will let me know. As around this query of Harshad seeks threshold limit of 5 crore in relation to GST audit will be including the exempted turnover also. Yes, so we'll have to go with the total amount of turnover, whether exempt or not, to decide whether the GST audit is applicable or not. And once that is applicable, after that you'll have to get on to that GST level audit. Okay, yeah. So let's take a break now. Hi. So we'll now continue with our discussion on this part related to the audit committee. Harshad is asking, do we need to remember the roles of the audit committee for the exam? Of course, yes. Everything which is there in the study material, you should remember that. And you should not really get into cramming of one of these points. Just try to understand some of these points conceptually. I know that some of these points you may need to memorize, but if you just try to get into the concept around most of these points, I'm sure you may not really need the cramming of all of these points, and you may be able to memorize that then for a longer bit of time. So now moving on to the requirements related to the audit committee from the perspective of or from this or as per the Companies Act. So what do we have here? Every listed company and following companies, means the companies which are there in front of you in this on the screen, will be required to have audit committee. So every listed company means irrespective of any of the criteria which are specified, and in respect of unlisted company, once again those unlisted companies should be all public companies, means public limited, means all private limited companies do not need an audit. And what's the criteria? All public companies with a paid up capital of 10 crore or more, all public companies having turnover of 100 crores or more, all public companies having in aggregate outstanding loan, debentures and deposits exceeding 50 crore rupees. Okay. Now, in respect of any of these companies, audit committee is mandatory. Means any of these companies will be required to have an audit committee in place, necessary. Yeah. Now, as around this paid up share capital or this turnover or the outstanding loans, debentures, deposits, these need to be looked at as on the date of the last audited financial statements. So that's the criteria one has to follow in terms of its assessment. Okay. Moving on to the next requirement related to this. Audit committee shall consist of minimum 3 directors with independent directors forming a majority. Okay. Now these are some of the requirements which you also see in case of LODR regulations. So let's move on to the functions of the audit committee. So what are the functions of the audit committee? Now herein you will see a lot of similarities in terms of the roles which the LODR regulations specified and some of the functions which are arising as per the requirements of the Companies Act. First, recommendation for appointment, remuneration, terms of appointment of the auditors, and this will be about the statutory auditor as well as the internal auditors. Review and monitoring their independence, performance, effectiveness of the entire audit process, something which we discussed in case of LODR also. Examination of the financial statements and examination of the report of the audit. Again, very important. Approval of any subsequent modification of transactions of related parties. You will say that so many points are common over here. Is that correct? Yes. Scrutiny of intercorporate loans investments. Valuation of undertakings or assets of the company. Evaluation of internal financial controls and risk management systems. Monitoring the end use of funds which are raised through public offers and release matters. All of this is the responsibility of whom? Audit committee. And most of these responsibilities we also saw to be similar in case of LODR regulations. Clear? Yeah. So let's look at some more requirements related to the audit committee. Now this is about the auditors, internal controls, etc. Subsection 5. So what does it say? Audit committee may call for the comments of auditors about internal control system. Scope of audit, including the observations of the auditors, review of financial statements before their submission to the board, and may also discuss any related issues with the internal and statutory auditors and management of the company. And will this really be relevant on the part of the audit committee? Yes, very relevant. Why? Because as regards the process related to this audit, it's on to the audit committee completely. Clear? Yeah. Moving further. Audit committee shall have an authority to investigate into any matter in relation to the items which are specified in subsection 4 or referred to it by the board, or for this purpose shall have power to obtain professional advice from the external sources and have full access to the information contained in the records of the company. Now, if you go back to the LODR regulations, therein we saw the same point. They have the power to investigate into the affairs as per the terms of their reference. And of course, something which is assigned by the board is what? That is their terms of reference. So can you see a lot of duplication taking place? But it's good. It's good that we are revising all of these points through the requirements of the Companies Act once again. Okay. Then talking about the auditors, KMPs, they all shall have the right to be heard in the meetings of the audit committees. They will also be participating in the meetings of the audit committee. Board's report shall disclose composition of audit committee, and where the board had not accepted any recommendation of the audit committee, same shall be disclosed in such report along with the reasons as to why the recommendations of the audit committee have not been accepted. Okay, yeah. Moving further, as regards this Vigil mechanism, we'll have a discussion on this slightly later. Now moving on to the review of information by the audit committee. So let's understand what is this requirement related to review of information. Now the audit committee shall mandatorily review the following information. Let's understand what is this information. And many of these things again you will find similar to what we have already discussed. First, mdna document. mdna, if you remember, is about the management discussion and analysis in relation to the financial information. That is mdna. Correct? That is mdna. Okay. Now this is something which is required to be reviewed by the audit committee. Next, statement of significant related party transactions. Now, related party transactions is one that is something which is pre-approved by them, but any of the related party transactions which would have taken place or the balances, those are also required to be reviewed by this committee. Management letters, letters of internal control weaknesses which may be issued by the statutory auditor. Now, at times, statutory auditor, even though he is not required to issue this, may issue some recommendations in relation to improvements of the internal controls. May also throw some light on the internal control weaknesses, even though it's not part of his audit report. Still, it's something which is an addition given by the statutory auditor, so that these can be improved upon by the management or by the audit committee or those charged with governance. So if any such things have been issued by the statutory auditor, those are required to be reviewed by the audit committee. Internal audit reports. Of course, this entire function is the responsibility of the audit committee, so they need to review this. Appointment, removal, and terms of remuneration of the chief internal auditor. Once again, it's the responsibility of the audit committee. Statement of deviations. Quarterly statement of deviations, including report of monitoring agency if applicable, and annual statement of funds utilized for purposes other than those which were specified in the prospectus or the offer document. So if the funds have been obtained and those funds were specified to be utilized for a particular purpose, but those are not utilized for a particular purpose, then those are required to be reported, and a statement of deviation is required to be prepared for that. Such statement of deviation is once again required to be reviewed by the audit committee as to what have been the reasons why all of these things would have taken place and why those may have been continued. So all of these are the responsibilities of the audit committee. Okay. Now moving further, you will see some of the things related to audit. I'll not want to get into too much details around this next part, section number 8 of this chapter, because we have already spent a lot of time on this. So I'll just touch upon some of these requirements quickly, because all of these things we have discussed in quite detail. Just give me 1 minute. All of these things we have discussed in detail. Now this talks about the role of auditor in relation to the audit committee, in relation to certification of compliance of conditions of corporate governance. Now, in relation to the audit committee, we have already discussed when we were discussing about auditing standards that there are various roles and responsibilities on the part of the auditor. And as regards the execution of those roles and responsibilities, as regards the reporting on the part of the auditor, various levels of communications are made by the auditor to the audit committee. Remember, communications to those charged with governance, and as around the responsibility of the audit committee, which is about, you can say, supervision of this entire audit process, including the statutory audit. You see a lot of interaction between the audit committee and the statutory audit. Yeah. So this talks about all of those aspects. So we'll just quickly look through all of these requirements. Auditor's responsibility. So what's the responsibility of the auditor? Auditor's responsibility in certifying compliance with the requirements of corporate governance, because this is slightly different, relates to verification and certification of factual implementation of requirements of corporate governance. This is something which, if any of you would have audited a listed company, they may be knowing that every year a certificate is required to be issued by the auditor, statutory auditor, to the company, wherein he would certify around the implementation, the requirements related to the corporate governance. And all of these are flowing from the requirements of LODR regulations, because corporate governance is all coming from the LODR regulations. Now, this is a separate certificate, and this is over and above the statutory audit. So that's why we can say that this certification is not a part of audit. This is other than audit. This is not about expression of opinion on the financial statements. That's separate. Okay. The certificate from the auditor as regards compliance of the corporate governance is neither an insurance as to the future viability of the company, nor the efficiency or the effectiveness with which the management has conducted the affairs. Because herein the auditor is only simplifying certain aspects, that is about implementation of corporate governance and certain requirements of corporate governance. That's it. Beyond that, he is not doing anything. Okay. Next. So what is it that is required by the auditor? Auditor needs to follow code of ethics. Auditor needs to be independent. Auditor needs to ensure that he has gone through the auditing standards. The documentation, etc., is required to be ensured by the auditor. And as regards the representations, the auditor will also be obtaining the management representations. Correct? And all of these things we have discussed. Now moving on to the next part. verification regarding the composition of board. Now, this is another role on the part of the auditor. So let's understand this role. So what is it that the auditor would do in terms of verification of the composition of the board? The auditor should ascertain whether throughout the reporting period, board of director comprises an optimum combination of executive and non-executive directors, wherein again certain criteria are prescribed, so I'm not getting into too much details around it. The auditor should also ensure that no listed company shall appoint a person or continue the directorship of any person as a non-executive director who has attained the age of 75 years unless a special resolution is passed to that effect, in which case the explanatory statement annexed to the notice for such motion shall indicate the justification for appointing such a person. The directors of the listed company shall comply with following conditions with respect to maximum number of directorships. A person shall not be a director in 8 listed entities, which is now 7 listed entities, notwithstanding anything above a person who may be serving as a whole-time director in any listed company shall serve as independent director in no more than 3 companies. For this, auditor should also verify, moving on to the next point, the auditor should also verify where the chairperson of the board is a non-executive director. At least 1/3 of the board should comprise of independent directors. Yeah. And then again, there are various limits which are prescribed here. Now let's try to understand as to what is really required to be done, because even if we touch upon each and every requirement which is captured over here, it may not be really relevant for us. See, what's the role? Let's try to understand broadly what's the role of the auditor. Every listed company or unlisted company, they need to ensure the composition of the board as per certain regulatory requirements. Those may be LODR regulations, those may be some provisions of the Companies Act. Now, what's the role of the auditor? Auditor needs to ensure that such composition which was prescribed, that has been continuing throughout the year. If that has not been continuing throughout the year, that is something which the auditor needs to report on. Because if there is any sort of known violation, if there is any sort of violation in respect of any of those provisions, then it comes down to the responsibility of the auditor. It comes down as the responsibility of the auditor to report any of such matters. Okay, clear? Now, in respect of any of such matters, where will this communication take place? How would the auditor really communicate regarding any of these points? All of these communications would be made by the auditor. First of all, to the management, will be discussed with the management. Then, of course, all of such communications on the part of the auditor will also take place with the audit committee. Okay. Now, moving on to the next part, that is about limited review of the audit of all entities whose accounts are to be consolidated with the listed entity. So let's understand this requirement. Statutory auditor of a listed company shall undertake limited review of audit of all the entities, companies whose accounts are to be consolidated with the listed entity as per Ind AS. This should really be Ind AS now, in accordance with the guidelines issued by the SEBI on this matter. Consequently, all listed entities whose equity shares are listed or convertible securities are listed, statutory auditors of such entities, all entities whose accounts are to be consolidated with the listed entities, and the statutory auditors of entities whose accounts are to be consolidated with the listed entity shall comply with the prescribed procedure. So let's understand what is this procedure which has been prescribed. So you can say this is about audit committee and corporate governance. Say A Limited, which is a listed company. It's a listed company. It has got various companies, and I'm just putting down all of them as subsidiaries for the time. Say it has got subsidiary 1, it has got subsidiary 2, it has got subsidiary 3, and subsidiary 4. And if you can just go back to our discussion on SA 600, this is very much in lines with the requirements over there. We are discussing about the provisions of limited review of the audit of all the entities whose accounts are required to be consolidated with the listed entity. Now, if you read this line, limited review of audit of all the entities. Which entities? All these entities are S1, S2, S3, S4, whose accounts are required to be consolidated with listed company. So their accounts will be consolidated with this listed company. Why? Because listed company will prepare CFS. Okay. Listed company will prepare CFS. So that's why their accounts will be consolidated over here. And that's why their accounts are required to be reviewed. Limited review means reviewed by the statutory auditor of this company. So let's understand about the statutory auditor. Let's suppose statutory auditor for A Limited is auditor 1. And statutory auditor for all these companies are A2. It's A2 over here. It's A2. It's A2. And this is also A2. So A2 audits all of these companies. Okay. Now the question is that during the financial year 2020-21, first reporting will be done on 30th June, because every listed company is required to present their quarterly results. 30th June 2020, 30th September 2020, 31st December 2020, and another reporting will be required on 31st of March 2021. Now, when it comes to the results at the consolidated level, which A Limited will present, the results of A Limited may be reviewed or audited by the statutory auditor of A Limited, that is A1. Okay, which is okay. That will be reviewed by A1. Up to that point, this was okay. But as regards all of these subsidiaries, these are not reviewed by A1. Why? Because you remember division of responsibility as per SA 600. A1 will not be auditing them. They are audited by A2. Now in this case, a question arises that the information which will move from S1 to A, S2 to A, S3 to A, and S4 to A, this information, even though it's audited by A2 or reviewed by A2, may still become subject to certain procedures by the auditor of A Limited. Who is the auditor of A Limited? A1. So that's the requirement which is specified over here. It says that A1 will perform certain procedures as around information of all of these subsidiaries for the purposes of consolidated reporting, which will be done by A Limited. Clear? Now question arises that will it become a duplication? Because S1, S2, S3, S4 may be audited by A2 and then once again A1 will audit this? No, it's not about duplication. So that's why it will very much go on the same lines like we have discussed in case of SA 600. But of course, certain procedures which are considered to be appropriate on the part of A1 will be performed by A1. Now those procedures will depend on the risk assessment, etc. Okay, clear on this requirement as to what does it capture? Okay. So now moving further. Moving further on to the remuneration of the directors. So let's understand what are the requirements related to remuneration of the directors. All the disclosure requirements regarding directors remuneration, let's understand them. Pecuniary relationships or the transactions of non-executive directors vis-a-vis listed entity, they need to be disclosed in the annual report. It's a mandatory disclosure. Criteria of making payments to non-executive directors needs to be disclosed. Alternatively, this may be disseminated to the list, disseminated on the listed company's website. Means instead of taking it to a report in detail, report over here is annual report. Okay, instead of just taking this in detail in that report, this can be put on the website of the company, and the website of the company, and the reference of this website as to where this information is put. That means that link will be specified in the annual report. So anyone who wants to get into the details while reading the annual report can go to the website and refer it. In addition to the disclosures which are required under the Companies Act, so that means over and above what Companies Act requires, following disclosures regarding the remuneration of directors will be made in the section of corporate governance. And corporate governance is some information, you can say, which forms part of annual report. Let's see what are those requirements. All the elements of remuneration package of individual directors summarized under major groups such as salary, benefits, bonuses, stock options, pension, etc. Details of fixed component and performance linked incentives along with the performance criteria. Service contracts, notice period, severance fees, stock option details. So you can say it's about the complete breakup, complete disclosure of the compensation of the non-executive directors, which is moved to the annual report, which is disclosed in the annual report. Moving further about on to the approval of the remuneration of the directors. Now, what are the requirements related to this? All fees, compensation, if any, which is paid to the non-executive directors, including independent directors, shall be recommended by the board of directors and shall require approval of shareholders in the general meeting. Shareholders' resolution shall specify the limits for maximum number of stock options that can be granted to non-executive directors in any financial year and in aggregate. However, approval of shareholders shall also be obtained by special resolution every year. In case the annual remuneration payable to a single non-executive director exceeds 50% of total annual remuneration payable to all the non-executive directors, giving details of the remuneration thereof. So that means if all the non-executive directors, let's suppose, are getting 10 crore, out of which one non-executive director is getting, say, 6 crore, then this will require approval of the shareholders through special resolution. Why? Because this is really crossing the limits. The requirement of obtaining prior approval of shareholders in the general meeting shall not apply to the payment of sitting fees to the non-executive directors. So this is only about the compensation that will go to the non-executive directors. And this sitting fees doesn't require this pre-approval if this is made within the limits which are prescribed, and this will also not require any approval from the central government. Okay, moving further, the fees or the compensation which is payable to the executive directors who are the promoters or the members of the promoters group shall be subject to approval of the shareholders by special resolution in general meeting if the annual remuneration payable to such executive director exceeds rupees 5 crore or 2.5% of net profits of the listed company, whichever is higher, or means if this is higher of these two, or where there is more than one such director, aggregate annual remuneration to such director exceeds 5% of the net profits of the listed company. Okay, yeah. Now let's understand that what is it that the auditor needs to do in this context. First of all, auditor will go through the minutes of the board of directors, through which he will get to understand about all of these things. Now he will ascertain from the meetings of minutes of the directors meetings, meetings of the directors or the shareholders, relative agenda papers, notices, or any other information, whether the remuneration of non-executive directors has been decided by the board of directors after receiving the prior approval of the shareholders in the general meeting or not. And this is very simple, because if all of these approvals would have been obtained, then there will be the relevant documentation around it, which the statutory auditor can check. Next, he will refer to the articles of association. If there is any restriction in the articles of association, he will need to refer that. Next, examine the report of the board of directors on corporate governance to be included in the annual report of the company, and ascertain whether the same contains the disclosures which is required to be included therein. And the auditor will also correlate this data with the data contained in the financial statements. You remember, when we looked at the audit report, auditor is required to comment on the information which is going along with the financial statements, whether that is consistent with the information included in the financial statements or not. So this is similar type of procedure, you can say, which he will be required to perform. Okay, yeah. So moving on to the requirements related to obligations with respect to employees, including senior management, KMPs, directors, and promoters. Now let's see what are these obligations which arise due to the regulations. So what are these regulations requiring in respect of all of them? As I told you, there are certain limits, etc. There are certain numbers as regards the time gap, as regards the number of meetings. All of these things, I would say, to some extent, you'll have to learn. So each and everything, I won't really say that you will be able to just understand. Some of these things you also need to learn and memorize. So let's understand the first point. The board shall meet at least 4 times in a year, with a maximum time gap of 120 days between 2 meetings. Quorum for every meeting of the board of directors of the top 2000 listed entities. Top 2000 listed entities, because from 1st of April, it's only the relevant period now, shall be 1/3 of its total strength, or 3 directors, whichever is higher, including at least 1 independent director. So similar to this requirement seems similar to what we saw in case of audit committee's requirement. Correct? I'm not saying it's same, but similarly we had this requirement over there also. Yeah. then there are certain criteria which are prescribed as around how all of these communications would take place between the members of the board. Moving further onto this requirement, I would say, okay, point number 3, please. The board shall periodically review compliance reports of all the laws applicable to the listed company, prepared by the listed company, as well as the steps taken by the listed company to rectify instances of non-compliances. Now, this is very important. I would say very important procedure on the part of the board, because if there are any significant non-compliances, then this may have a bearing on the organization as a whole. And when it comes to the compliances, it's not something which is about very, very small compliances that we are talking, even though the responsibility of the board is towards everything. Yeah, which is about small compliances or the big compliances, but there could be certain compliances which may be impacting the operations of the organization. Yeah, and generally you'll see the board will have a discussion on some of the very serious matters. So that's why we will say it's one of the most important procedure on the part of the board. Non-executive directors shall be required to disclose their shareholding in the listed company in which they are proposed to be appointed as directors prior to their appointment. These details should be included in the notice to the general meeting called for appointment of such director. Next, an independent director shall be held liable only in respect of such acts or omissions or commission by the listed company which had occurred with his knowledge, attributable through board processes, and with his consent or connivance, or wherein he had not acted diligently with respect to the provisions contained in the LODR regulations. So basically, it's about putting the responsibility on the independent directors, that independent directors will become responsible in respect of any acts or omissions, or say any non-compliances, if those would have taken place and those were within the knowledge of the independent directors, but they didn't take any step to rectify that. Okay, yeah. Moving further on to the requirement, an independent director who resigns or who is removed from the board of directors shall be replaced by a new independent director at the earliest, but not later than the immediate next board meeting or 3 months from the date of such vacancy, whichever is later. Where the listed entity fulfills the requirement of independent directors in its board even without filling this vacancy which is created by resignation, the requirement of replacement of new independent director shall not apply. Because let's suppose if this new independent director would only add to the minimum number, then we'll not just consider this number. This may be done or may not be done, but this number has to be of the minimum level. If that goes below the minimum level, then of course this requirement will have this time frame which needs to be ensured. Okay. Board of directors of the listed company shall satisfy itself that the plans are in place for orderly succession for appointments to the board and to the senior management. Okay. Now moving further, as around the compliance of laws and regulations. Now, as around the compliance of this laws and regulations, whose responsibility is this? It's the responsibility of the management. Remember, whose responsibility is this? It's the responsibility of the management. So that's why when it comes to the management, they need to ensure all of this. So this is again something which we discussed in case of this essay, and we understood that even though the auditor will be performing procedures around it, but primarily it's the responsibility of whom? it's the management, it's those charged with governance. So they need to take care of all of these aspects if this has not been complied with. All right, clear? Moving further on to code of conduct. So let's understand what is this code of conduct and how this is required to be maintained. Once again, it's the responsibility of the board of directors, who shall lay down a code of conduct for all the board members and the senior management of the listed company. It's up to the board of directors. All the board members and the senior management personnel shall affirm compliance with the code on an annual basis. Third, the annual report of the company shall contain a declaration to the effect that this code of conduct is in place. So therefore, this responsibility has also been passed on to the Chief Executive Officer of the company. Code of conduct shall also be posted on the website of the company. So this is something which is available in a public domain. In fact, in case of a listed company, you will see that most of the things are available in the public domain. Yeah, it's all about transparency. Transparency in terms of various informations, various requirements, various compliances which the listed company needs to ensure. The code of conduct shall suitably incorporate the duties of the independent directors, which are laid down in the Companies Act 2013. Okay, clear on this? Yeah. Moving on to the next part, that is about Vigil mechanism. So let's understand the Vigil mechanism. And this is again something which we discussed earlier. You remember when we were talking about the requirements related to the Vigil mechanism? Yeah. So let's understand what is this Vigil mechanism. The listed company shall establish a Vigil mechanism for the directors and the employees to report on genuine concerns. This mechanism should also provide for adequate safeguards against victimization of directors, employees, or any other person who avail the mechanism, and also provide for direct access to the chairman or the chairperson of the audit committee in appropriate or exceptional cases. The details of the establishment of such mechanism shall be disclosed by the company on its website and in the board's report. So let's understand what is this Vigil mechanism. See, it's about a process. It's about a system which is required to be put in. And this system is just to safeguard the interests of the company, of the organization. Let's suppose if there is any individual means any employee of the company who finds some wrong practices being conducted over there. Now, what's the next step for this employee to report to? He will always have his immediate senior wherein he can just go approach. But let's suppose there is a collision which has been going on. So the senior personnel or the senior management is also involved in those wrong practices. Now, what's the course of action? So what's the mechanism which is available to that employee who just wants to get this improved or get this rectified? So that's why for such type of things, this Vigil mechanism is made available, wherein this person may just reach out to the chairperson of the audit committee directly. But that will again be on an exceptional basis. It's not something which can happen on a daily basis. First of all, these instances will be rare. And secondly, even if these instances occur, so this collision you'll not find it every time. So whenever this is required to be this should be available to the employees or at times the directors also. But the important thing is about its disclosure and about its communication to the all employees of the company, and that's why this is available on the website of the company, and this will also form part of the policies and the procedures of the company. Okay. Moving further on to the criteria of a subsidiary of a listed company. Now this is something which is important. As per regulation 16C, let's understand what do we mean by a material subsidiary. Material subsidiary would mean a subsidiary whose income or net worth exceeds 10% of consolidated income or net worth. Consolidated means the one which is appearing in consolidated financial statements. And this criteria needs to be looked at in the immediately preceding accounting year. Regulation 24(1). So we have another regulation. This provides that at least one independent director on the board of directors of the listed company shall be a director on the board of directors of the unlisted material subsidiary. So can you understand the relevance of this material subsidiary? So we are saying that at least one independent director out of this listed company's board will also become the director of its unlisted material subsidiary. Okay. Now, for the purposes of regulation 24(1), notwithstanding anything to the contrary contained in regulation 16, the term material subsidiary shall mean a subsidiary whose income or net worth exceeds 20% of consolidated income or net worth respectively of the listed company and its subsidiaries in the immediately preceding accounting year. So let's understand. So let's understand this criteria. So we are talking about a material subsidiary. Subsidiary whose income or net worth subsidiary whose income or net worth exceeds 10% of, this exceeds 10% of consolidated income, this exceeds 10% of consolidated net worth. Okay. Now such subsidiary will become material subsidiary. And which regulation talks about this? Regulation 16C. Okay. So this criteria of material subsidiary, will be used everywhere, except in one case. So there is an exception to this definition of material subsidiary. Let's understand the exception. So what is the exception? In case of regulation 24, wherein the appointment of independent director of the listed company is required to be done for unlisted subsidiary. Instead of looking at 10%, or instead of considering this to be 10%, we will consider this percentage as 20%. Only for regulation 24(1). Clear on this? Yeah? Only for this regulation, We will change this percentage as 20 and then derive the then derive whether this subsidiary becomes material or not. Otherwise, everywhere else, if we have to check whether this subsidiary is material or not, what is the percentage will apply? 10%. Clear? So now moving further on to this. Audit committee of the listed entity shall also review financial statements, in particular the investments made by the unlisted subsidiary. Okay, so this is all about review of the information of the subsidiaries. The minutes of the board meetings of the unlisted subsidiary shall be placed at the board meeting of the listed entity, and this will also be reviewed at the parent level in a way. So basically we are saying that the information of the subsidiary will be reviewed at the parent level. Moving further on to some of the criteria. A listed entity shall not dispose of shares in its material subsidiary, resulting in reduction of its shareholding to less than 50% or cease the exercise of control over the subsidiary without passing a special resolution in its general meeting, except in cases where such divestment is made under a scheme of arrangement duly approved by a court or tribunal, or under a resolution plan duly approved under section 31 of the Insolvency Code, and such an event has been disclosed to the recognized stock exchange within 1 day of the resolution plan being approved. Next, selling, disposing of, and leasing of assets amounting to more than 20% of the assets of the material subsidiary on an agreement basis shall require prior approval of the shareholders by way of special resolution, unless such scheme that is cleared by the court scheme. Where a listed entity, moving further, where a listed entity has a listed subsidiary which is itself a holding company, so we are talking about listed subsidiary below which again there is a subsidiary. The above provision shall also apply to the listed subsidiary insofar as those are related to subsidiaries. Okay. Moving further on to the secretarial audit. Every listed company and its material unlisted subsidiaries incorporated in India shall undertake secretarial audit. Secretarial audit therefore is mandatory for listed companies. Okay. Moving further on to next type of committee. So we discussed about, if you remember, audit committee, we discussed about board of directors. Similarly, listed companies will also have another type of committee. What is this committee known as? Nomination and Remuneration Committee. Okay, so it's the type of committee which is required to be set up over there. So let's understand the role of this committee. The board of directors of every listed company shall constitute this Nomination and Remuneration Committee, which shall comprise of at least 3 directors, all of whom shall be non-executive directors, and at least half shall be independent directors. Okay. So let's understand the role. I think the most important point for us again is not really to get onto all of these numbers, etc. Because as I have told you that the numbers, etc., all of these things are something which you'll have to just learn. So let's understand what's the role of this Nomination and Remuneration Committee. Very important aspect of this. Formulation of the criteria for determining qualifications, positive attributes, independence of director, and recommend to the board of directors a policy related to the remuneration of the directors. KMPs and other employees. So when it comes to the remuneration of the directors, when it comes to the remuneration of the KMP and some other employees at senior level, it's this committee which decides about it. It's this committee which assesses their qualifications. Okay. Next, formulation of criteria for evaluation of performance of independent directors and the board of directors. So this policy for evaluating the performance of directors is again the responsibility of this committee. Devising a policy on board diversity, because again the diversification of the board of directors is important because the organization has to take care of so many aspects. Yeah, and all of this is the responsibility of the board of directors. Identifying persons who are qualified to become directors and who may be appointed in the senior management in accordance with the criteria laid down and recommend to the board their appointment and removal. So now as regards the persons who are qualified to become directors, qualified to be a part of the senior management, its appointment will be done by whom? Board. But its recommendation will be from this type, from this committee to the board. Whether to extend or continue the term of appointment of independent director on the basis of the report of the performance evaluation. This again will be done by this committee. Recommend to the board all remuneration in whatever form which is payable to the senior management. So that means it's all about the evaluation of the performance. So that means it's more of the role of HR. But when it comes to the HR function of the organization, it's towards the employees. But this HR function in relation to the directors of the company is played by whom? This committee. Okay. So we have got another committee. Now in case of listed companies, committees do not come to an end, and that's why in case for listed company, there's big list of compliances which are required to be complied with throughout the year. Stakeholders Relationship Committee. So let's understand what is this committee. The listed company shall constitute a stakeholders relationship committee to specifically look into various aspects of interest of stakeholders, debenture holders, other security holders. And the chairman of this committee shall be a non-executive director. Then once again, we have the number of directors, etc., which is available for this type of committee, which you can just read later on. We should move on to the role of this committee. So let's understand what is the role of this committee. Sorry, I think I missed out on some of your queries, Ambika and Jay. I'll come to your queries slightly later, please. So moving on to the role of stakeholders committee. Resolving the grievances of security holders, including complaints related to transfer, transmission of shares, non-receipt of annual report, non-receipt of declared dividends, issue of new or duplicate certificates, general meetings, etc. Review of measures taken for the effective exercise of voting rights by the shareholders. Review of adherence to the service standards adopted by the listed company in respect of various services being rendered by the registrar and share transfer agents. Review of various measures and initiatives taken by the listed company for reducing the quantum of unclaimed dividends and ensuring timely receipt. So if you can see, most of these functions are related to the stakeholders, shareholders. So in case they have not been receiving the dividend, in case there is any transfer of shares, etc. So all of these things, all of these queries, if you talk about any listed company, they are numerous. So that's why a separate committee is required to be established so that all of these queries keep getting resolved in a timely manner. Otherwise, this may also have an impact about the reputation of the company. Yeah, all of these stakeholders may get impacted, and those persons are very, very important for the listed companies. Moving on to another type of committee, risk management committee. So let's understand about this risk management committee now. So what is this committee? What's the role of this committee? Now, once again, who will constitute this committee? Board of directors will constitute this committee. And there's again number, criteria, etc. for this committee. Board of directors shall define the role and responsibility of risk management committee and may delegate monitoring and review of the risk management plan to this committee and such other functions as it may deem fit, and such function shall specifically cover cyber security. Now, what will be the role of this committee? To look around the risk management plan. And this is again a very focused area of the board of directors, and for which the board of directors may really want a separate committee to focus on in case there is a need for this. This is again not a mandate, but generally you will find these type of committees being set up wherein the risk management, etc. are required to be strengthened by the board, wherein they feel there is really a need to do this. Okay. Now, if you remember, we talked about a statement of deviations or variations, but we didn't get into too much details around it. Yeah. So let's understand about that statement of deviations or variations. So what is this? The listed company shall submit to the stock exchange following statement on a quarterly basis for public issue. So why would this be issued? Why would this be given? In case there's a public issue, right issue, preferential issue. So then it will go to the stock exchange on a quarterly basis. And what would this cover? It will indicate deviations, if any, in the use of proceeds from the objects which were stated in the offer document or explanatory statement to the notice for the general meeting as applicable. Indicating category-wise variation means what has been the variation? Variation is in capital expenditure, sales and marketing, working capital, between the projected utilization of funds made by it in the offer document and the actual utilization. So basically, this statement would all about the variations, deviations. When the company would have rolled out an offer document, the prospectus, the company would have specified that how would these funds be utilized. But if those funds are not getting utilized the way those were given in the prospectus, then this deviation is required to be reported there. And if you remember, audit committee also has the responsibility to review this on a quarterly basis, in fact on a regularly basis, as to why these deviations have been taking place. Yeah. So this statement is also required to be reported to the stock exchange. Now, as regards the audit committee, they shall mandatorily review this quarterly statement, which will be submitted to the stock exchange, annual statement of funds, which is utilized for purposes other than those which are specified in the offer document or prospectus. Okay. Now moving on to some more disclosure requirements. So all of these, as you can see, are coming from the requirements of LODR. All of these are based on LODR regulations. So in case of an appointment of a new director or reappointment of a director, shareholders must be provided with the following information. So this is all about providing certain information to the shareholders. A brief resume of the director, nature of his expertise in specific functional areas, disclosure of relationships between directors, names of listed companies in which the person holds the directorships, and the membership of committee of the board, shareholding of non-executive directors. Now, many a times when you see this communication, it's one, available on the public domain. So it's available on the website of the company. Secondly, these are also required to be reported to regulatory authorities, to the stock exchange, etc. So that's why these are very much available in the public domain. And when it comes to the information like resume, etc., so you'll not see any CV, like all of you may be sharing your CVs, etc. So it's not about that CV, it's about the particulars or the profile as to the experience or the expertise of the director, which is briefly captured. Okay, clear? Now moving further on to the requirements related to compliance certificate. So let's see what this compliance certificate and what are the requirements around it. Considered to be a very important document in case of a listed company. So let's see. CEO and the CFO shall certify to the board. So you can say it's an internal document, but it's a very important document in the organization because it's about placing responsibility on two very key personnel of the organization, who are those CFO and the CEO. And that's why they are certifying it. They are not making a communication to the board. They are giving a certificate which is signed by them to the board of directors, because it's something which is assigned to them, that they have reviewed the financial statements and to the best of their knowledge and belief, they do not contain any materially untrue statement or omit any material fact or contain statements that might be misleading. These statements together present a true and fair view of listed companies' affairs, and they are in compliance with the accounting standards, applicable laws and regulations. These are to the best of their knowledge and belief, there are to the best of their knowledge and belief no transactions entered into by the listed company during the year which were fraudulent, illegal, or violative of entity's code of conduct. They accept responsibility for establishing and maintaining internal controls for financial reporting, and that they have also evaluated the effectiveness of internal control systems of the organization in respect of financial reporting, and they have disclosed to the auditors and the audit committee if there were any deficiencies therein. They have indicated to the auditors and the audit committee if there are any significant changes in ICFR, if there are any significant changes in accounting policy which have been used for preparation of financial statements, if there are any instances of significant fraud which might have taken place or which they may have become aware of. So all of these, anyways, you would understand would generally be the responsibility of any employee of the organization. But these two happen to be the KMP generally, and that's why this task has been specifically assigned to them, and wherein they are also taking a big responsibility because they are certifying this. And when they are certifying this, they are issuing this certificate to the board of directors. Okay, now the responsibility which is entrusted to the CEO and CFO in relation to establishing and maintaining internal controls over the financial reporting. So what does this require? It requires, first of all, they will have to comment about the effectiveness of the internal controls. Secondly, they will have to comment about any deficiencies which may be contained therein. Third, that they will also take any steps to rectify those deficiencies. Okay. Now, as around this, though we have talked about this in so much detail, auditors are also playing a big role. And in respect of listed company, a separate audit report is required to be issued by the auditor in respect of ICFR. Yeah, that is about internal controls over financial reporting, wherein the auditor also needs to test the controls around those areas which may have an impact on the financial statements of the company. Yeah, and any of the significant weaknesses, etc., are required to be reported thereon. So it's again an opinion which will go out from the auditors, that means the statutory auditors of the company in the form of a separate audit report. Moving on to one document which we have discussed quite a lot, and that is called as mdna. mdna is all about some analysis which the management would have done in relation to various aspects of the business and the organization. And let's understand what are all those matters which are discussed in this mdna document. So this mdna document talks about the industry structure and the developments, opportunities and threats for the organization, any segment-wise or product-wise performance that is required to be discussed over there, which may be helpful or the useful for the users of the financial statements or the financial information which could be there in the annual report, outlook of the organization, what are the risks and the concerns for the organization, internal control systems and their adequacy, discussions on financial performance with respect to operational performances, management developments in human resource, industrial relations front, including number of people which are employed, details of significant changes. Now, what could be those significant changes? Change of 25% or more as compared to immediately preceding financial year in key financial ratios. For example, debtors turnover ratio, inventory turnover ratio, debt equity ratio, net profit margin ratio, current ratio. Yeah, all of these ratios, if those have been changing significantly in the current year as compared to the past years. Details of any change in the return on net worth as compared to immediately preceding financial year. So all of these aspects are required to be covered therein and discussed over there. Okay, yeah. So with this, we are almost done on this part related to audit committee and some of the aspects related to the LODR regulations. I would say there are some small disclosures which LODR regulations talk about, very small disclosures which are still left, and I think some new guidances or some new requirements related to the resignation of the statutory auditors which is left, which I think should not take more than another half an hour for us to conclude this chapter. But due to this time constraint, I don't think we'll be able to wrap it up. So this remaining part we'll have to take up in the next session. And in the next session, the immediate next session that you are going to have is on the internal audit, operational audit, which will be taken by somebody else. So when we meet next, so that means next to next session, we will be covering the remaining part of this chapter. Okay, yeah, so clear. So I'm saying the remaining part of this chapter, small part which is pending, will be covered by us in the next to next session. So I'll now move on to your queries. I think some of your queries got missed. So Ambika is asking about the criteria of unlisted material subsidiary, and she's asking 20% requirement is only for unlisted material subsidiary. Yes. That means for appointment of independent director in unlisted subsidiary, it's 20. Yes, only for regulation 24(1). Harshad was asking, sir, while reviewing the audit at the time of consolidation, can the statutory auditor ask the auditor of subsidiaries to amend his audit report if the statutory auditor has come across some discrepancies that are material? Of course, yes. Jay is asking, what will be the impact of contradictory regulation 10 to 20? These are not contradictory. These are standing at two different places. And that's why there is a proviso. Then Sumit is asking about board diversity. See, board diversification means people should be from various domains. Because please understand that the board is not only looking at the financial statements. Board is looking at organization as a whole. So this should have an expert from HR area. This should have an expert who is an expert on the operations of the organization, who is also an expert about the financial performances, about the finances. so that they can contribute around each and every element which is important for the growth of the organization. Sumit is then saying, sir, money raised from IPO should be used for which it's been raised. Yes, of course. Then Sumit is asking, at each quarter this has to be reported. Yes, of course. Not with the quarterly results. This goes as a separate document. Okay. Yeah, clear? So with this, we can just end our discussion for today, and in the next session we will starting with a new chapter, and that is NBFC, but that is next to next session. Your immediate next session is on internal audit, I understand. All right. Thanks to all of you once again, and thanks for your wonderful participation.